Hey everybody, it's Ken and Danille.
Hey, hey.
And we're here with Jay Parsons, and I'm really excited about this because Jay is the Deputy Chief Economist. Now that's a big title, Jay, for RealPage. But what's most important for you guys to know is that RealPage does analysis on 19 million. That's 19 million worldwide units. About 12 to 13 million are based in the U.S. And he is frequently talking on a number of stages about rental housing, single-family housing, HOAs, asset management, property management, risk management, all over the place. He's been in the Wall Street Journal and Bloomberg, CNBC, the Pension Real Estate Association, Mortgage Bankers Association, National Apartment Association, and American Banker and Globe Street, which hopefully you guys all know about. But the point is, this guy really knows his stuff. Jay, welcome back.
Thank you, Ken. I don't know if I can live up to that intro, but I'll do my best.
Well, it is pretty cool to have you on because I think, what everybody wants to know for next year is kind of what's happening, where's it all heading. And so I was excited that you're going to take the time for us and for our viewers today to be able to, go into some of these stats. I think that it's confusing. There's a lot of, the Realtor and Zillow and Redfin, they all just came out with their projections. You guys have yours. I like you, look at ULI and NMHC, and, we look at very different data, but there's lots of different information with lots of different points, which actually I kind of like.
Yeah.
But I don't know anybody that measures the amount that you guys measure. So I'm really excited to dig in deep. Before we start, why don't you talk about what's your normal day, week, month like around there, and how do you dig in all this data and kind of predict things?
Wow, that's a good question. So yeah, it used to be a normal day would be hanging out in the office and right outside Dallas, but now it's a lot of Zoom and Teams meetings like everybody else, and of course now we get to do a little more traveling this year. But we through RealPage with the benefit of seeing data coming out of property management systems and revenue management systems. So we're aggregating data from all the different owners and managers across the country that we work with, and then and really weekly or monthly, just trying to we're always looking at inflection points, trying to understand where things are changing, and then we can obviously adjust our forecast accordingly, as well as just talking to people. I'm a big fan of data is a great bird's eye view of what's happening in the world, but when you talk to people living it every day, you definitely get a fuller perspective.
Yeah. And so for those of you guys that might not know, what he's talking about is my own company has our information with the software platform with RealPage. And so when somebody moves in or moves out, or occupancy goes up or rent goes up, it's reported at the RealPage level. Isn't that right, Jay?
Yes. So all of the, I think as most people know, is like every lease lives on the so-called rent roll, right? And so we're taking all that data on the rent roll, everything from the, so it's always the asking rents from a website that make headlines, but it's really everything else is more interesting. It's what lives on the rent roll, the incomes of the renter signing leases, the number of days vacant between leases, the trade out, the retention rates. Those are all things that we get excited about.
And guys, I think you should all know that those are really important. I mean, it's easy to read a report and then try to make some decisions based on that, and you should do that. But all the nuances inside of a rent roll, all the nuances of people moving out of an area or moving into an area or rent growth, and all that stuff is important.
Maybe you should explain what a rent roll is to some of the audience.
Sure. So, good point. So, on let's say you have a 10-unit apartment building. Each person is listed on what's called a rent roll. It's literally just has the unit size, the unit square footage, how much the rents are, the deposits, all that stuff is on a rent roll. Obviously, the name of the people that are in the place, it matches the lease. So that's all a rent roll is. So if it's two people, that's all there is. There's two people on your rent roll. But if it's 200, then you have all of that as well. But you also have vacancies. So, and you have all anything and everything that's inside of the people that are living in an apartment building or on the rent roll. And then each individual tenant has their own ledger. So, and that's also reported. So you can imagine, like, let's say you're a delinquent, and let's say you paid late 5 times in the last 12 months. Well, that will all be reported as part of this software package. So RealPage can actually dig down into various types of data and take a look at really real time, literally.
So if you were going to buy like a 5-unit apartment complex, and you could see that 2 of the people are constantly late on paying rent, it would just be good data for you to have when purchasing a unit.
Yeah, of course. Yeah. And that, if they would obviously be on the RealPage platform, the software, but and of course, this is what we're trying to do here is we're trying to give an idea of what's going on in an individual city, individual state, where people are migrating, where rents are going, and that's kind of the beauty of RealPage, because how many markets do you guys cover?
Oh, it's everywhere. I mean, 300 plus MSAs. And let me just briefly say, we only look at aggregated data. So I'm definitely not looking at individual, tenants, and obviously there's confidentiality things and all that. But it's fascinating though to see the data in real time and how it moves.
Yeah, it's pretty neat. So let's jump right in here. I think that we've all established that, Jay, you are the man pretty much. And I think everybody kind of wants to know what's going on with 2022. So now what was interesting is the National Association of Realtors. They said that rent growth is going to continue to 10% into 2022. What do you guys show?
Yeah, we're forecasting high single digits, 8 to 9% nationally. So very similar. I think it's going to be tough to match 2021. I think if you're in the rental housing business, if you talk to people who've been in the business for 30, 40 years, they'll tell you it's the hottest year in their lifetimes. And I think for most of us, regardless of when we retire, 2021's probably still will be the hottest year in our lifetimes in terms of just supply demand fundamentals. So 2022, and I can get into the reasons for this. I don't think it's going to be quite as strong as 2021, but by comparison to any other year, it's still going to look very, 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 very strong.
I know. Well, I remember years where we're going backwards. So I'm grateful that it's interesting. We bought a bunch of stuff in Houston this year, I think, as you know. And I just saw something come out in Globe Street that said that they trended 11% in 2021.
Yeah, it's Houston was a market that got a little bit a slower start than the rest of the Sun Belt. But it's on fire. But everything's strong right now. Going into this year, we were talking about the big coastal cities being kind of laggards, and now they're starting back up. And quite frankly, faster than I expected. And so I shared this stat the other day on one of our presentations, but you asked how many markets we cover. So of the 300 plus markets where we have sufficient data, there's only 6 in the entire country with more than 6% vacancy, which that's incredible. I don't know if everybody understands how significant that is, but that's crazy. And those 6 are tiny places. It's like 2 places in North Dakota, and not even like one of the 2 or 3 biggest markets. And then like Midland, Texas, oil boom market and bus market. And then there's one other one. A couple others I'm drawing a blank on, but they weren't the places everyone's familiar with. They're rushing to go to.
So said another way, let's see, 294 markets are under 6%.
Yeah, under 6% vacancy. Yeah, and the national average is 97.5 occupancy, which is just unheard of. Our data goes back 30 plus years. Have never seen it above 97% occupancy. And then it's just hard to find a place to live, whether it's a single family rental, a multifamily rental, or even a for sale home. We have a big shortage of housing right now.
We do, and we talk a lot about this. One of the things that I fear is affordability. We have rent. There's supposed to be a good balance between supply and demand. Right now, it's out of balance, as you know, and so certain markets are having really high rent growth. What are some of your top markets that you think are going to be for in the next 2022?
Yeah, no. Well, again, if you don't mind, let me first talk about the affordability thing. I think with, to your point, I look at a different way. I don't think we have an affordability crisis. I think there's an accessibility crisis. And the reason I say that is if you look at the market rate rental sector, vacancies at all-time lows, demands at all-time highs, and rent income ratios for new lease signers, which of course is when we look at income, hasn't changed. And so the challenge, so thankfully, we're seeing massive income growth in the segment of the population that rents market rate. The problem, though, is we're not building enough housing, especially for the lower income households. And so you have a growing pool of people who never were able to afford market rate. And at the same time as market rate supply is growing, affordable supply is not. And so they're just further being left behind because of governments at every level failing to adequately support and to fund affordable housing.
Yeah, 100% agree. For those of you guys might not know, so we had the director of housing from Arizona on, and a few months ago, and you know what happens at the city level, guys, when you're trying to build something is they have this thing called density. It basically says how many you can build on there, and so the smaller the amount, the higher the cost. And then you have other things what are called impact fees, which are how much does it cost to actually develop and build in a certain market. I got a package last week. The guy in the city of Phoenix, the guy worked 4 years to get an approval. 4 years to get an approval to build an apartment building. So the longer that happens, and by the way, there has to be a process for approvals. Don't get me wrong,
right?
But those lags are real, and now we have these construction cost issues. So we passed on it because the construction costs are so high, and we're looking at close to $3 a foot rents in Phoenix. And I'm like, I don't know that I would ever pay $1,000 times 3. It's $3,000 per month for an apartment that's not affordable. So you have the impact fees, the land costs, the delay, the lag. And then you have, when it's actually done, from a developer standpoint, the only way that you can make that work is if the math works. And the math doesn't work, right? Isn't that what you're saying, Jay?
Yeah, no, I think, yes and no. I think at some point we're going to hit that, right? I mean, the good news is developers are still finding that the incomes are going up so much that they can support it. But, at some point in certain areas, certain cities, it just doesn't. I mean, look at Los Angeles, a classic example of an area that has just made it way too hard to build housing. And I talked to a developer out there, Class A plus one, that took more than 10 years, to get a deal approved. I mean, the world changes a lot in 10 years, and a lot of developers, and of course, as you know, it's not just the developers, it's the money behind them. They're not willing to wait that long.
Well, not even just that, but I mean, as far as affordable housing goes, if construction is that expensive, who's going to want to build affordable housing if it doesn't make sense for them financially?
Yeah, and that's why we need more government support for it. I mean, I talked to an affordable housing developer a couple of weeks ago, and he said it actually costs him more to build affordable than market rate because the affordable programs, there's usually some tax credit involved. They make you go through a lot more red tape that costs more. At the same time, land costs the same, materials cost the same, labor costs the same. And, cities and states have got to make it easier to get these deals done. In fact, if anything, make it harder.
Well, and that's a good point because, I know people that have thought about converting their units into Section 8. And there's so much red tape and application and they have to fix it up that they're like, screw it. Why would I even do it in this market? Because there's a shortage of rentals. So I could just rent it to somebody else.
No, you're absolutely right. I mean, on the surface, we should be doing more Section 8 and we need it. But, if you're a property owner, you're torn because it's the right thing to do, there's demand for it. But, we're seeing all over the country people saying, I don't know if I want to go through the regulatory headaches that are involved with that.
Yeah, and I think there's a massive amount of bureaucracy. I think is kind of the point on building something and converting something and making something affordable. It shouldn't be, but it is, and so it's actually much easier just to build traditional market rate housing. Unfortunately, right, Jay?
No, it is, and a lot of cities are starting to require, as I'm going to build 300 units and we'll set aside 5 for affordable, and they call that a win. But that's a drop in the bucket.
Yeah.
Right.
We need to be building thousands and hundreds of thousands of units in these big markets for affordable, not 5 and 10 here and there.
And I think what maybe people don't realize is that we want to.
Yeah.
I mean, we want to. But what happens is by the time you have all you guys want to really blow your mind, because I looked this up. The LA County tried to do this affordable housing program. Gosh, I think it was 8 or 9 years ago. And I read a whole article about it. By the time it was done, the units were somewhere north of $500,000, $600,000 of cost. By the time everybody had their hand out and the fees and the politicians and everybody had a piece of the deal, I guess. And by the time the actual affordable home was actually built, it was very, very expensive housing to construct.
Well, that's not shocking, because when we studied the homeless crisis, didn't they start a homeless camp, and it ended up being $5,000 a month per campsite by the time
true.
all of the
That's true.
But
we digress. So so anyway, the point is, guys, look, if you're listening, we want to build. Developers want to build affordable housing. Landlords want to put affordable housing in place, but some of the policies that are in place, they don't make it easy.
No, you're right. And just one last point on that is that, I think we're in an environment right now where obviously there's a lot of pressure coming on to property owners and housing providers, but where there needs to be more heat on policymakers at every level, because if you can't build affordable housing without government support, it just doesn't pencil out. And as long as we keep passing Band-Aid measures that don't really create more housing, and kind of passing the buck onto the private sector, then we're not solving the problem. We're just making it harder and harder for people to access housing, and ultimately, kind of, if anything, limiting supply.
Yeah, and rent control is one of those Band-Aids, and it's
absolutely,
people use those words because they're powerful. Those two words are very powerful together, but it does not work. Proven. All you got to do is go and look in California, New York.
Well, your most expensive markets have rent control.
I know Oregon passed that New
York City.
Yeah. It doesn't work. It sounds sexy and it sounds like it should work, but it doesn't work.
Yeah, no, you're right. And, we're seeing similar new language. Good cause eviction is a new term in New York. And it sounds like, hey, good cause eviction, I'm all for that. I mean, nobody wants wrong cause evictions, right? Well, you read into the details and it's really just rent control and a lot of other regulations on housing that's going to make it more difficult for rental housing owners, not only to build housing, but also to fund ongoing maintenance for housing.
Right. And that's the other piece. We can go down the rabbit hole on rent control. But let's jump to, I saw on your Twitter that the median age of renters has dipped below 31 for the first time. So that was interesting to me. Can you walk through what the reason is, or what you think what happened there?
Yeah. So I think this who the renters are, I think, is a fascinating topic. And when you look at how policymakers portray renters, it's usually they would have you kind of paint this picture of every renter as a renter by necessity because they can't afford to buy a house. And all this, and I get asked all the time, it's like, hey, all this demand for apartments, it's really because people can't buy a house, right?
Yeah.
It's like, no, it's not. Like, and I think that data helps show that. Like, if the issue are people not being able to buy a house, you would expect to see renter ages going up because people are growing up older, their life stage are changing, but they can't get into a single family home. But rather what's happening is it's the same demographics that traditionally are in apartments. And we've actually gotten a little bit younger, and that reflects the Gen Z boom now coming into early adulthood and now, entering in the apartment market.
And I've definitely noticed that with my rentals, most of my renters, almost all of them, basically stay in my rental until they save up and buy a house. That's like the next thing, like we're buying a house, so I feel like.
But and to your point, Jay, we actually have a lot of people that just literally don't want to buy a house. They want a really nice place to live.
Yeah.
and they're just kind of seeing, dude, is this where we want to be? Because maybe they're there for a year, 2 years, they permanently don't want to, right?
Yeah, I think that's also a big reason why this, build for rent, single family rental boom are so strong as well. I mean, if you have, the increasing quality of the single family rental market as well as the apartment market, I think has changed the desirability of rent in a lot of cases. Not for everybody, but I think for a contingent of the population.
Plus, with work from home, they might not want to settle down in one location. They might want to
Right.
be able to travel and go where the weather's nice
Yeah.
and get their work done.
That's changed a lot. People are exiting with their cash and they're relocating, and they're kind of deciding, do I want to be here? And that was one of the questions I wanted to ask you before we jump over to your projections on retail. But do you see a flight to affordability? Like, do you see, like, I don't want to pick on Ohio, but I will because she's from there. But obviously people are buying there, they're renting there, and they're doing it because it's safe and it's affordable. Do you see that happening more and more and more as people are trying to take a look at because wage growth is definitely not keeping up with inflation?
Yeah, no, that's a good question. I think, we definitely see that in spots. And by the way, I like Ohio. My dad's family's from Cleveland, so I'm with you.
See? Exactly.
Yeah, I mean, I think there's going to be cases, of course, where the flight to affordability, it's not just the housing, but it's also just the general cost of living, right? It's taxes and the availability of jobs and whatnot. I mean, this is a big reason why the Sun Belt has grown as much as it has over the past few decades. It's been significantly more affordable than the coastal cities, and it still is. But it's also getting more expensive in some of these cities, and so there's a lot of forecasters who are getting more bullish on some of the Midwest cities in particular. And I'm of the view that, and I think it was maybe Redfin in particular, but I'm of the view that the Sun Belt still has a lot of legs left in it. But also, I think I do think that we're going to see some good steady growth in some of these Midwestern cities as well.
And what's interesting about some of these small towns, in Ohio where I'm from, or Coeur d'Alene, Idaho, they don't have very many rentals because people more traditionally would own a house because it wouldn't be that expensive to rent. So I think that, interestingly enough, from what I've seen in my small town, even compared to Scottsdale, while it's less expensive to rent, it's not as less expensive as you would think. Now, the home prices are very different. In Scottsdale, it's much more expensive than certain parts of Ohio, but the rental prices aren't as different as you would imagine. And I think it's just because there's not that many rentals.
You're right. I mean, you look at the Midwestern states, they've not built much housing in the last few decades. I mean, most of the big Midwestern cities, like Cleveland's and Detroit's and even Chicago's, I mean, other than downtown Chicago, I mean, most of the rentals that exist were built in the 50s, 60s, and 70s. And so we've grown at a much slower pace since then. Yeah. And so that means that just a lot less supply is still out there. And so vacancies still tend to be very low, even in these lower demand markets, just because there's not a whole lot of supply, to your point.
Yeah. And also, if you can buy a house like a 3-bedroom house for $130,000 and, put a 3% interest rate on it, or go pay $1,200 a month for an apartment, it really makes sense all day long to just buy a house, there, more than in like some of these markets like Arizona, where a same house would probably cost you $500,000. And then, or you could pay, $2,200 in rent.
So Jay, I'm from the Northwest, so I'm a Seattle kid and have stuff in Portland, and we were up there this summer, and and I don't want to get too political here, but when we were there was homelessness, there was the defunding of the police, there was the crime was a lot higher, and I actually put up for sale a property that I had there because I was like, I think this is be kind of a rough market moving forward, and my listing agent said, it's tough right now, based on what they're seeing and what the market's seeing. So are you seeing, without picking on any kind of city, but different policymakers are making different decisions in different areas with regards to all these things, the safety side, the the homelessness side, and all those kinds of things. And we have issues all over, as you know. Do you feel like that's having people are moving? Because we're seeing it. I've talked to a number of people that are moving from Seattle, Portland, San Francisco, into Arizona based on some of those factors. What are you guys seeing?
Yeah, no, it's a great question, and I'm not sure that all that's played out yet. I mean, I will tell you on the on the capital side is we're seeing a lot of, and I think most recently just because of the policy approach toward rental housing with eviction bans, but also things like screening limitations and renewal rent caps. Because of these things, it's creating, I think, a more awareness around policy risk for investors. And so we've seen some migration of capital away from those cities, the big coastal cities, and into the Sun Belt and in the Midwest. And I think, in terms of the population, obviously there's been some of that as well. And I think the cities in general will always be appealing to a segment of the population. But obviously it's been a very bumpy road in those cities the last couple of years. Everything from the social unrest issues, but also the city lockdowns are obviously more severe there than elsewhere in the country during the COVID period, and now the regulations after. So it's definitely been a choppy road.
Yeah, it has. And so what's Jay's saying there, guys, is that big money, to call it institutional money, is actually looking at a market, and they've done this all over the place anyway when there's overbuilding and stuff like that. So the money kind of decides, hey, this is a market we don't want to be in because of rent control, because of rent caps, because of the moratorium, because obviously they're only going to lend in markets where the landlords could pay them back. And so if they're going to hedge on the income side, and what's coming next, I think, is going to be the real estate taxes, because real estate taxes have to go up to kind of support some of these other things. So the landlord or the person who owns it is getting squeezed. Is that accurate, Jay?
Yeah, no, it is. And I'll give you an example of like St. Paul. I mean, St. Paul was the one that just passed rent control, and right after that, we saw a lot of, and this made a lot of news, a lot of investors backed out, or the investors behind developers backed out of building new housing because rent control there was going to apply to new construction. And the rent control advocate said, hey, this is, how can they do this? Why are you doing that? And it's a 3% flat cap. And what a lot of them don't understand is that it's not just the developer, it's the lenders and investors behind them oftentimes are tied back to pension funds, retirement accounts. It could be, individual investors that are, part of these. We think of institutional, it's just like, sounds like the big guy on Wall Street, but it's a lot of everyday Americans and their accounts tied up in this. Well, most of those accounts required to generate a return around 6, 7, 8% in order to then get those proceeds back to your everyday average Americans invested in the retirement account or whatever, which doesn't necessarily mean 7% rent growth. As you know, it gets more complicated than that. But the point being is that, as an investor, it's everyday Americans who are tied into these things. And so they're required to reach certain returns. And if they don't get that, they have to go find it somewhere else.
Yeah, exactly right. So the money moves. I know when Oregon passed the rent control, we decided not to invest in Oregon for those kinds of reasons. It's because you want more of a free market society. If you're gonna use your own capital, you don't want all those restrictions.
Yeah, and ultimately, I think that again, it's an example where I think if we can just build a lot more housing, that would solve the issues.
It would solve a lot of issues.
Yeah, no, we need it, guys. I mean, we need supply. So let's jump over to retail. It's been interesting. Retail's been on the block for a bit, especially with all this, direct to consumer stuff. And you think of Amazon, I guess, as one of the leaders there. But is experiencing a 10-year high for leasing and investment right now?
For retail?
Yeah.
I don't follow retail quite as closely, but it's definitely bounced back. But remember, it's coming from a very low comparison point. It's always those year-over-year comparisons that are tricky. So it's definitely remained a choppy period for retail. But it can really, I mean, much more than rental housing. It varies a heck of a lot by location.
It does. I know. What's interesting. I feel like maybe retail is like, drafting on multifamily. Like people are just trying to, put their money into debt, right? And this low interest debt to try to hedge inflation a little bit, because there's a lot of retail that's in trouble, as we know. Yeah. And it's looking like it's going to get worse.
Yeah, and a lot of that is, I think, is tied to you're betting as much on the underlying real estate at this point than the value of the land as much as you are the retail income.
It's for sure. So let's jump over to the PwC and ULI report, which I know you love. I love. I think a lot of people that are really heavy in real estate, trying to figure out where to buy and hold and sell and all that kind of stuff. This report is. I think it's a couple hundred pages. It's a fantastic read.
So what does it
easy
measure?
Reading.
Yeah. What's that?
What does it measure?
It measures office, retail, industrial, multifamily, single family. It measures markets. It measures rent growth. It measures just a number of things. It's pretty detailed. But one of the things I picked up in there was on this office space, because everybody's wondering about office, right? I own some office. And the office space utilization, the work from home, it's basically saying that it's going to decrease between 5 and 15% through 2024. What are you seeing on that?
Well, yeah. First of all, with the ULI report, just to put a little bit of context and humor here, is that a few years ago, so the ULI report is not just ULI and PwC, as just so everybody knows, they survey people like us and get our takes on it and then put together a report based on our feelings. Well, those of us who participated a couple of years ago said that Houston would be the top market for real estate investors. Then oil prices crashed and ended up being the worst market. So take it all the way to the grain of salt, even though I love the report too. But yeah, it's the office topic is obviously a fascinating one. It hasn't fully played out yet. I'll tell you, for our own company, is we have 500,000 square feet outside of Dallas, and it's 10% occupied on any given day. And I visit our clients, and it's pretty similar. I mean, it's a small share of companies that are really fully back to office. And so because of the nature of office leases that are obviously longer term, it's not like a residential lease. I don't think we've seen the full impact yet of COVID and the work from home. So if I were actually betting, I would probably take the over on the ULI than the under. Unfortunately, I'm not excited to say that, but I think it's unfortunate.
I read an article. I think it was Pinterest wrote a close to a $90 million check for a buyout of their lease.
Wow.
So obviously they calculated what it's going to be to have all their people come back, and all you got to do is Google it and see it. And so what Jay's saying is that these leases are 5, 7, 10-year leases, and as they start to renew, obviously if you're utilizing 10%, you're probably going to reevaluate how much space you actually need.
Well, we did look, though, and see that they think some of the small office spaces may do okay because the big office spaces will migrate. How do you feel about that?
Yeah, I mean, I think everything's undetermined at this point. So I want to, take a little bit less level of confidence in this particular statement. But I think that as this plays out, I think that the idea that there's more flexible workspace where maybe you're sharing space with other companies, obviously most companies are smaller companies. They can be more flexible. Obviously a large company is always going to have some dedicated space. But, I think flexible space where people are, I've seen some cases now where even in the same company, no one has a desk anymore. You just kind of use some workspace while you're there. I think we're going to just kind of get to a new normal where, shared office space, shared, multiple, just more efficient utilization of space.
Yeah, that's what we're doing actually here at our firm is, we're hiring 106 or 108 people next year. And we're trying to keep them all in the same space by doing that shared concept, because also we're okay with people working from home a couple days a week.
Yeah.
So with that model, it does and can work. So that's actually going to be a benefit to us.
Yeah. Well, and the good news too is that, I think everyone's found that productivity is still really, really high in the remote model. We've seen that at our company, and And so I think in some ways it's, we all kind of knew this was a growing trend prior to COVID, and COVID was sort of the test kitchen that we were all forced into and showed that, for a lot of jobs, a lot of companies, not everybody, but for a lot of jobs, this can work.
Well, and especially with a tight labor market like it is now, it gives you a national reach to find the best talent.
Yeah,
Absolutely.
I know. In fact, that's exactly what we've been doing. We've been hiring and letting people live in Chicago or Florida, or as long as they do their job. And you can, like, to your point, when we first started talking, you can Zoom and you can talk to people and then just have them come into the office from time to time to connect.
Yeah. That reminds me, I saw an article the other day. It was advising job seekers in areas where there's not a lot of jobs available, just saying, hey, expand your search to Texas and Arizona and Florida and just see if they'll take remote workers, because why not,
Right, it's worth a shot.
Yeah. Oh, well, thanks for putting that out, because we need people.
Yeah, MC Companies is hiring.
Yeah. So let's turn to senior housing. Like, senior housing got beat up a little bit, and obviously what was in the news was, COVID, and they shut them. My mom was in like ground zero, right? Because I'm from Seattle, and actually north of Seattle, in a place called Everett, and she's in a assisted care home, and so it's there's different levels of senior housing. So first of all, I think everybody needs to know there's ones that need a lot of care. And there's actually active senior, which is 55 plus, and there's also variations in between. But it's had kind of a negative year, just generally, which is interesting because I think baby boomers were retiring at like 50,000 a day or something. So but what do you see coming? Because it looks to me like senior housing is going to be really a bigger ticket for the next 10.
Yeah, I think it's a good question. And with COVID. I think it's important with COVID to kind of separate kind of your temporary phenomenon, your long-term one. And if you're a day trader, then obviously there's a period of time then you wouldn't want to be in senior housing. But for most of us in housing, you're not. You're a long-term holder, and you're making long-term bets. And I don't think COVID structurally, not like office, I think senior housing, the underlying equation didn't get massively disrupted. I think that it probably paused some decisions in terms of moves and whatnot. But to your point, those demographic drivers are still there. And one last thing on that too is, a lot of the retiring boomers right now are still in, the active adult stages of life where they can really live anywhere. So I think as that peak population, or that group that's kind of younger senior adults now, as they get older, I think you're still going to see more demand for senior housing.
What do they call it? The gray tsunami or the silver tsunami, right? Not me. So let's jump to single family, because I think a lot of people that watch this are heavily into single family. And Realtor, their economists predicted that the number of homes for sale, which is hovering around record lows right now, will only tick up like 0.03%. I saw that. It's interesting because, by the way, there are Redfin and I think Zillow have a little bit different variations. What's your spin on the listings, supply, all that stuff?
Yeah, no, I tend to agree with them. I mean, the problem is that, every time you measure demand, it's really just a measure of sales activities and listings. And it's the same thing in rental housing. Like, demand is just, you can only absorb what you have available. And clearly there's a lot of pent up demand that cannot be captured because there's not a lot of supply on the market. And there's really, there's two challenges. Number one is that we're not building as many single family homes as we did in the past couple of decades. And what we are building tends to be move up homes. It's very rare to find starter homes anymore. And then on the other side of it, I think that obviously you've heard this point a lot, is that if you're a seller, the question becomes, okay, well, what am I going to buy if I do sell? And if you don't think you can find something that is desirable to you and affordable to you after you sell your house, then, it takes away the motivation of selling and taking that cash.
Yeah.
Well, and definitely. You don't want to be sitting on the cash.
No, that's actually the reentry is the issue. Okay, so we had like 12%, I think, house prices on the average or something for the country. Obviously, they're different in different markets and all that. And Realtor said that they're going to be 2.9. This might be the first time that I've actually seen rents are purportedly, I guess, supposedly going up much quicker than home appreciation. What do you think about that?
Well, I mean, if you still have low inventory and people are still buying houses, which I don't think. I think if you have low inventory, it's going to reflect there's still a lot of demand for housing, meaning like low short time on market. I didn't say that very well, but meaning like I don't think those demand side stories are changing. And so that being the case, I would take the over on the 2.9%. I think home prices will grow more than that, but I would think that it'll be pretty similar in both the for sale market and the rental housing market. I think we're going to see a come down from the double digit numbers of 2021, but still pretty strong numbers compared to kind of previous normals.
I agree with you. Yeah, when I saw that, I thought it was actually quite low. I felt like I don't see any relief. There's still a lot of affordability out there in certain markets. There's certainly there's markets that are not, but people are still migrating still. And, the pandemic is still raging on, and there's still new variants coming and things like that. So it feels like the single family side is going to have still a very, very robust year, albeit the next piece, which is I'd love to get your take on interest rates, because the Fed has come out and said they're going to stop this bond buying. I think 120 billion a month, and they're going to try to do it by March. I read June, I read March. So what do you think is going to happen? Because with that, they say at least that they're going to tick rates up, but that's going to slow things down. So what do you see there?
Well, there was a Freddie Mac economist put out a chart recently showing kind of consensus forecast for interest rates versus actual interest rates movements over the last 10 years. And it pretty much shows what to expect, which is that economists always think it's going up, and it never has gone up over the last 10 years. And so I'm starting to put it in the bucket of oil prices, of things that I don't want to forecast and be on the record with, because they're very hard to predict. I mean, it's, I guess if I had to get pinned down on it, though, I would say that we may see a little bit of interest rate growth, but not as significant as probably some are saying. I think it'd be more modest.
Yeah, it's interesting. By the way, for those of you who don't know, the Fed meets 8 times a year, I believe. And they've said that they could raise it up a quarter point, which is a quarter or that's about right, I guess, on the average. But to your point, what happens is if rates go up, then people buy less cars, they buy less homes, they buy less TVs, they buy less, right? Affordability gets even worse.
Yeah, and the problem now is the Fed has to, and I mean, they have a tough job because they have to balance that with supply chain issues and the fact that it's hard to find these things anyway. And so when you already have a supply crunch, I think that their concerns probably about just messing things up even more. But and I honestly, I don't even know what I would tell them to do. We're in very unusual times right now.
We're trying to balance, the inflation with the rates, with the supply chain issues. There's a lot going on.
There's a lot going on.
Yeah. I read, which I completely agree. I think it was Zillow said that what they expect is people are going to harvest a little bit of that cash or some of their savings, and they're going to reinvest it in their own home in the form of improvements. Is that what you guys are seeing too?
Yeah, no, I saw this, I'm trying to remember, maybe it was Zillow, somebody else. There was an article about how, with all the home price appreciation, instead of just selling and taking the money and buy something else, I mean, you're doing the cash out refinances, and people are investing that money back in their house, or they're, saving money for big new things they want, so I think that's become kind of the better way, I say better more as, their decision, that's become the preferred way to use that money.
Yeah, it sure appears that way. And I don't know about I can't remember how many we have on our renovation teams, but I know we have, somewhere between like about 15 million under renovation right now. And it's really hard to get supplies and labor
Yeah.
right now because of all this kind of movement. People are renovating and staying put.
Oh yeah, we went through this. My family and I, we did a renovation in our house last year, and it was supposed to be done last Thanksgiving, and we didn't move back in until March, and we're still at punch list items. I'm still waiting on my guy to do. So
That's right.
I feel the pain personally.
Yeah. Well, so treat your contractors well, guys. Treat those tradesmen well, because they are gold coming in the next couple of years. Let's finish up on this, great resignation piece, and what's happening right now. It's looking like we have pretty interesting wage growth, big labor shortage, high unemployment. It's kind of a weird time. You got this aging population, you got these new guys coming up, and you got work from home, and all of this stuff. Where do you see all this heading?
Yeah, it's a fascinating topic. I think of all the ones, this is the one that probably concerns me the most, because I'm not sure where this goes. I mean, in the Great Resignation crisis, it's interesting. It's really just this great reshuffling of what's happened of workers, because we've seen people are jumping out for new jobs that pay more. They can work from anywhere, more flexibility. The Federal Reserve's beige books, they do these surveys of people, of businesses across the country, and they're reporting these just massive wage increases everywhere. That's much more significant than what the Bureau of Labor Statistics, which reports kind of the traditional wage growth, is reporting. And so I think that the income growth that's happening right now at all pay levels is probably more significant than the headline numbers indicate. Anecdotally, I've seen this among my own circle at our work and among my friends, and where just the pay to leave to somewhere else is just so significant, and that in turn puts pressure on employers to pay more for the staff they do have, because they can't afford to have a lot more turnover. So I think, this is probably, people always talk about inflation, it's always focused on, milk costs more, gas costs more, apartment rents cost more. But there is another good piece of it, which is most people, again, I want to be respectful, because not everybody's going through this, but most people are also getting paid more. And so if we can keep wage growth in line with everything else, then that's not a bad thing.
Yeah, we just, her brother just decided, just to throw his hat in the ring. He was working for a big company, and the company gave him like a 20% increase in pay and a big signing bonus.
Yeah, $20,000 signing bonus.
Yeah, he was kind of, well, maybe I'll just take a look. And I know we're having the same kind of situation with people coming in, and what's the good news is that they luckily we have a culture that people want to work in, thankfully. So they're sharing with us, hey, I've got this on the table over here, and I'm like, wow, we're seeing big chunks in wage growth right now with every position.
Yeah. No, I mean, the recruiters on LinkedIn are out there like crazy. I've heard several times from people on my own team, it's like, hey, I wasn't looking, but,
Yeah.
Well, when somebody throws an offer at you, you're like, whoa,
Yeah. I don't fault them for
Jay,
that.
I got to tell you, we hired a full-time recruiter, employee recruiter in our office, because it's so competitive. We've never had to do that before. We're in our 20th year, and she's been gold, because she's going out and doing a lot of the legwork. It's very different. Before, we all kind of relied on resumes coming in, and we have a position. Let's sort through these now. It's super competitive at the moment.
Oh yeah, I mean, I'm sure you relate to this as well. I have a couple of job openings right now, and we've had I've had just today found out 2 people who thought were going to be going forward with interviews back out because they found something else already.
Well, we had somebody start today. My CFO, we had an assistant for my CFO. She's like, "It's a good day." I go, "Why?" She's like, "They showed up." I'm like, yeah, it's sure. So Jay, I've taken enough of your time. Thank you so much. What's the best way people can reach you? Where should they go for some of this information if they want more?
Yeah, thank you. We have a blog at realpage.com/analytics. And then I also post pretty much every day on LinkedIn and a little bit on Twitter, but so you can find me there as well. We're always talking real estate and rental housing in particular.
Awesome. Well, thanks, Jay. Very nice to chat.
Jay, as always, I appreciate everything you do for our company, and the information too is super helpful as we're navigating new markets and trying to figure out what to do next year. So thanks for your time.
Hey, thank you. Thanks for your partnership, and thanks for having me.
You bet. Cheers.